Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 20th of 2024. Over the last week, we got a lot of inflation-related data. We got the Producer Price Index, the PPI, for the month of April, as well as the Consumer Price Index, the CPI data. And they painted really two kind of different kinds of pictures, if you will. So, obviously we've been tracking this inflation trend over the last year. Obviously, we've been in a disinflationary mode. This last month on PPI was a bit of a surprise. So you can see here, as we look at these estimates, survey consensus was for 0.3%. We wound up getting 0.5%. Over here, survey looking for 0.2% on the core, and we wound up getting 0.5%. You can see the red bars here, how they compare. So, obviously we were trending down. You saw some benign numbers here, as well as a downtrend here significantly on the core side for producer prices. And then notably over the last several months, in both these cases, you've got an uptick. And so, again, a little bit more concerning as we got into the middle of the week last week. As some of the inflation forecasts and interest rate forecasts seem to kind of been thrown by the wayside. The probabilities of rate decreases, after this report kind of almost went to zero for a while before I think some calmer heads kind of prevailed in all of this, knowing that this data can still be pretty lumpy. And we've actually had some really good progress in producer prices over the last year. And so having a month that was a little bit outsized was not that big of a deal. And then, of course, later on during the week, as we'll see in a couple of slides, we got consumer price index data that was better than expected. And so we saw kind of almost a wholesale reversal in sentiment here. Now we look at core PPI, excluding trade services. So we know service inflation has been running a little bit hot. And so, this is really something that, I think was what got the goat, really, when you're talking about consumer prices, looking about 3.1%. And again, 3% honestly is going to be, in my judgment, kind of a new normal. For many, many years, financial planners use 3% as a yardstick for annualized inflation. And so it's only been over the last really decade to 15 years that we got used to inflation that was a lot lower than that. And so the Fed's target here is 2. Again, we're within striking distance of that, although this last report, the last couple of reports represented an uptick. And again, this is, X services. So, and this is core X services too. So strips out food and energy. But if you translate that over into what we're going to see likely in the PCE number, which is the Fed's preferred inflation gauge, we do anticipate that is going to come down because we have a lot of the components, and these these are calculated differently. And so it's important to note that you have some input costs here that, again, by this estimate are not likely to persist. They're kind of one-off, that maybe we see that leveling out around 3%, and maybe we have a downtick next month. We'll just have to wait and see. But all of the inputs that go into calculating PCE, or personal consumption expenditures, or what they call the deflator here, are all trending down on a month-over-month basis. And so we have that to look forward to as a dovetail to what we're seeing in the consumer price basket. And here we have kind of an overlay of CPI in the dotted black line. The CPI year over year in the April reading was up 3.4%, and the core was up 3.6%. And you can kind of see where that kind of falls in here. And then we're also looking at hourly earnings, which remain high, but they are coming down. So we've been watching wages, and obviously real wages are still positive here because we've got hourly earnings that are still above the rate of inflation. So, that's a positive sign for workers and savers, especially at a higher yielding environment here. But again, positive takeaway from this is that, even though you have kind of a flattening out, if you will, of overall CPI, like really over the last year, or at least 9 to 10 months or so, it's corresponding with this gradual decline in hourly earnings and potential decline in overall owner's equivalent rent that we've been waiting for quite some time, because we see observed rents being much lower than what's being represented and calculated within the inflation numbers. We talk about money supply, which is something that when you have a lot of it and you have fairly robust money supply growth, contributes to inflation. And when that money supply goes negative, that will eventually take away from inflation. And that's where we are now. So you look in this darker line here represents a year-over-year change in M2 money supply. You can see that during the pandemic, that was running north of 20%. For quite a while. And so it was only a matter of time before inflation reared its ugly head. Well, money supply growth then ensuingly, dropped and actually has been negative for quite some time. And as we look at the overall level of M2 money supply, and you draw a line of best fit, again, not necessarily the best thing to do just for 2 years, but if you draw that line of best fit here, guess what? We're about where we would have been had we continued along this trend line here. We just have this bloated money supply, and then the actual level of money supply in the system declined, and now it seems to be flatlining here, even after the year-over-year changes are all negative. Here we have M2 money supply divided by GDP. So again, as we were talking about before, the trend lines would tend to suggest that we're kind of getting back to normal, if you will. And so if you draw this line of best fit, you're right about there. And again, we had this big bubble of money supply relative to economic growth. And so, where we are now, money supply is about 74% of GDP. And again, back on long-term trend lines. We've been talking about the yield curve being inverted and the whole lending environment. And, it's funny, I talk to some bankers that say that they're lending money, at a return, talk to other bankers and they say they're not. We talk to some of the larger bankers and their loan committees are getting a little bit more conservative, and they're taking, increased reserves against potential future loan losses. And again, if those don't materialize, then those banks are going to bleed that back into earnings over time. But here we see the 10-year to 3-month Treasury yield spread. It remains negative, as it has been for quite some time. We did see a little bit of relief as we got through 2023, and this is when rates really blew out in 2022. And then, of course, we're still negative to the tune of about 1.5 percentage points. We got inflation. This is a really good chart because it talks about real rates, and this, we talk about like real wages, we talk about real prices. This is kind of the mechanism by which that happens. So, in this amber line, represents inflation. We know inflation, we've been in a disinflationary mode for a while, and then as we saw a few slides ago, this is kind of flatline. So inflation's gone down. This is the Fed funds rate. So these are short-term interest rates. We know that we went through a period, obviously in 2022 here, that was what really drove the market nuts, as we had all these rate increases and they got up here, and basically we haven't had a rate increase for about 12 months, or not quite 12 months, but we haven't had any rate change for quite some time. And so that's flatlining. And so what happens here now is you got in the blue line the real Fed funds rate, which is the adjustment for inflation, and you could see that real rates are now going up again. So this is a real rate of interest that's now around 3%, and that's simply because you've got a point where you've got lower overall inflation and still high interest rates. All right, we talked about bank lending standards, and so we do see banks remaining a little bit on the tighter side, and obviously throughout the course of the last decade, banks were pretty easy on credit, and that was following, the period ahead of the global financial crisis when credit was super easy. And, we're not quite there yet. We're trending in that direction. So, I think this to some degree is kind of like maybe put the brakes a little bit on what economic growth would have otherwise been like. And we are expecting a pretty good economic growth print here in the second quarter. We're like 1.5, 1.6 here in the first quarter, which is a little bit on the weak side, but we expected that. Now the print's likely to come in here as we get into July for the second quarter, or possibly going to be, maybe at least double to even triple that first quarter number. And as we see the lending standards continue to trend towards basically the equilibrium line here, we would expect, that this to continue to have a little bit of an overhang on that growth. But if we get into an easing condition, perhaps later this year or maybe even, beginning of next year, that would have implications that would suggest that there's staying power to the overall growth that we're seeing in the economy. We'll talk about restrictive monetary policy here on this chart. So this is something I've been talking about for actually quite some time, where you have, by definition, you have a restrictive policy environment where you've got short-term rates that are still above the rate of inflation. And usually, those two should probably fall in line, and where you get your term premium is in the 10-year treasury and the longer dated maturities. Right now we don't have that because the yield curve is in fact inverted, but we do have a restrictive policy environment just because those short-term rates are above the rate of inflation. On this chart, we've got a couple of things going on here. We've got the Chicago Fed National Financial Conditions Index, and that's in the blue line. We've got the Goldman Sachs Financial Conditions Index in the amber line there, and both are, tend to show very favorable conditions. And this is a time series that goes back to 1992, and you can see generally that when you get into recessions that you see a little spikes in this time series. Right now, the data is still continuing to trend down. So financial conditions have by and large been very favorable and have been for some time. Here we have some leading indicators, employment related. We do have employment, small business hiring plans, and we do know that small businesses have been a little bit more conservative as of late, and then average weekly hours worked. And you can see both of those in this case trending down. So this shows that, tells us that the labor market is weakening a bit. It's not, again, catastrophic. It's not, it's very normal and expected given the circumstances. And we just showed you the slides where policy rates were still restrictive, and that we still have banks that were on net tighter than they were several years ago on their credit. So, this is a circumstance that we would absolutely expect given those conditions. Here we have a decline in temporary workers, which typically precedes a rise in unemployment. And again, labor markets are still very tight, but as we can see here, the temporary help services, this is inverted, so this is actually going down. This is temp help that's going down, and then the unemployment rate here on the left axis is still at near, basically, generational lows, and we'll expect that to move up a little bit. Again, that's not unhealthy at all. Here we have labor force participation, which is really interesting. So in the pandemic, we saw participation period drop considerably here in the dislocation. And, what we've been talking about a lot over the last several years is the fact that that really hadn't picked up that much. And you see here, when you get 55 years and older, you see that cohort really not working as much. But what's interesting is you get in 65 years and over, we've actually had an uptick in the labor force participation rate. So It's just be interesting to kind of dig into the details a little bit deeper on all of this. But suffice it to say that, this is, once you have more labor supply in the equation, that obviously is going to drive up more people looking for work and potentially the unemployment rate, perhaps. From a wage standpoint, since there's, if you have an uptick of maybe some of these workers getting back into the workforce, then, it's a law, basically the law of supply and demand. You have more supply, that's going to drive overall wages down. It will certainly help businesses and profitability. It won't necessarily help real wage growth, but this is a very interesting dynamic, and you can see how both of these were kind of trending up ahead of the pandemic. Talk about excess savings and kind of continuing our theme with the consumer here. So you can see here that you've got personal savings in this blue line as a percent of disposable personal income. So, think of this really is that personal savings rate. Well, pandemic, we got a lot of checks in the mail, a lot of stimulus, and that led to a glut in savings. And that's what partially led to inflation, certainly led to goods consumption, and then eventually service sector inflation. And then, what's been happening since then is that we've gone negative. So we've been burning through those savings, and net excess savings in September of 21 has been to the tune of negative $2 trillion. And we are about exhausted in that excess surplus. And it will be very interesting to see what happens to consumption as we head into 2025. Talk about credit here. So this is, more about the consumer. And so we have this noticeable uptick in delinquencies, and you can see, this is just total debt, right? And so it's looking at the components that are like more than 120 days late, and the amount that's severely derogatory. You generally don't tend to worry too much about this type of lateness, but when you get over here, that's when you start to get a little bit more concerned. You can see that those two components have trended up on a monthly, or I should say a quarterly basis, consistently over the last year. Then you slide over here into credit cards, and these are plus 90 day. Again, this is like this territory right here, but except just for credit cards. And, we do see a lot of younger generations maxing out cards, and we see this delinquency rate, at least for that age cohort, be a lot higher than some of the other ages. And you can see here that that's pushing 7%, and which is a level that we haven't seen since we were on the downslope following the global financial crisis. Here we have on the consumer debt side, you've got in the amber line, you've got the Fed funds rate, and obviously we know what's happened there. Rates have gone up, and they've kind of held flat for a while. And in the blue line, we have a household debt service ratio. And the thing here is that we still have a lot of mortgages that are below, they're certainly below 4%. And there's quite a few mortgages that are still below 3%. And so, and people have been very reluctant to move. So mobility is really shut down. But, being that, a house payment is typically the chunk, a house payment and then a car payment after that are going to be the lion's share of your monthly debt service, that number really hasn't changed that much. And so I think this is what gives people comfort, certainly economists comfort in, the ability for consumers to continue to support consumption heading into the latter half of the year, even with these ultra high rates. We talk about production, manufacturing. We've got U.S. manufacturing that was a little bit weaker than expected. You can see the red line here. You can see the production, using 2017 as an index. We are, below that level, and we had a little bit of a downtick. But as we see, like on the manufacturing index side for the Philly Fed, that was below expectations as well. although in the Philadelphia Federal Reserve region, overall manufacturing remains positive. But we did see a noticeable downtick in new orders. And so, you get into some of these months here, again, you look at this time series just going back maybe over the last year and a half, and you're apt to see as many down months as you are positive months. So, to the extent that this is habit forming, we would be concerned. But right now, you can see that follows, a really, really strong quarter 2 quarters ago, and then last quarter, which would be essentially the last quarter being a little bit positive, and so this is essentially just a partial reversal of that. So, long story short, this data can be pretty lumpy. Manufacturing is still a little bit sluggish, but there is some hope on the horizon. So here we have manufacturing PMIs, and anything above 50 represents expansion. So we actually, in April, the manufacturing PMI, and this is a national number, not the Philly Fed or the data that I just showed you in that last slide, but you can see that popped up above 50 for the first time in 17 months. And so we've never had a prolonged downturn in the PMI without having a recession. And then here we are like pumping through, 50. So as I said on the last slide, there is hope on the horizon here. We've got activity indexes. These are basically, these are surveys, right? So the respondents on balance are saying that, both current and future activity that they feel is trending in a positive way, even though these both had little downticks. But again, if you can keep that data above here, and those PMIs are at least close to 50, I think that is the recipe for a soft landing. We'll talk about, again, survey respondents, talking about what is giving them, a lot of discomfort in their business, what's impacting their cost structure. Not too surprisingly, we find that labor is still the most important part, but something that's really been causing a lot of heartache lately on the inflation side is commercial insurance. We know those rates are moving higher. Goods and inputs, this number was a lot higher about 2 years ago, but it is coming back. So we do see, basically the fear of, input costs weighing down margins, and then employee benefits, which is always in that probably the top 6 or 7, but we see here, and then the cost of capital, and then obviously rent are all things that we have to take into consideration here in the current environment, and these are all things that do contribute to inflation. Here we have small business optimism, and we know that this has been weak lately. Small businesses tend to be a little bit more pessimistic than large businesses. A lot of reasons for that. I mean, access to capital, cost of capital, generally reserves, liquidity, cash flow is generally not as great for small businesses as it is for larger businesses. And so, with higher interest rates being one of the primary culprits, we do see, this number remaining pretty soggy. And so, we've got hiring plans, have gone down. Again, this is symptomatic of the, some of the stuff that we saw on the labor chart with temporary hiring going down, which is usually a precursor to some trimming of workforce and other workforce reductions. You got job openings, which ironically kind of uptick slightly, but you can see clearly that downtrend here over the last several years. And so, you've got the prospect of labor kind of softening up, but honestly, that's not necessarily a bad thing. And you look where we're coming from. I mean, we are still very close to generational lows in unemployment. So it's not like we're talking about a really terrible situation. Here we have inflation expectations. So considering everything that went on last week, right? Everything that went on with PPI, CPI, and so we're looking here at inflation expectations over the next 3 years. And so, we're not down at the 2% that the Fed wants, but the inflation expectations are pretty well grounded, as you can see that they have been in the past during periods of even lower actual realized real-time inflation. the 3-year expectation number has kind of been in this 2.5 to 3% range, and that's where we are again now. So I think this is more normalized, and again, I think from a financial planning standpoint that it would be prudent not to use the Fed's targeted 2%, but something that's between 2.5 and 3%. Now, if you're talking about just 1 year ahead, then that number is still about 3.25. But again, long-term expectations are a little bit more subdued, as you would expect them to be. Talk about the 2-year Treasury note, and as we've seen, a real pickup over relatively short period of time. About the last, if you go back a few weeks, about a month prior to that, we had some pretty elevated expectations for interest rates, feeling like, okay, well, we're not going to get those 6 rate cuts that we thought. That inflation's a little bit sticky, and we're going to have to put up with this a little bit longer. But as you can see, a lot of this can be fairly short-lived, and we've seen a noticeable downtick in rates. And some of that has to be, or some of this is related to foreign ownership of U.S. Treasuries. And in fact, the Chinese are selling. We've got a couple of charts coming up a little bit later here, but you can see 2-year Treasury note yields are definitely coming down. Now we've got mortgages, and so with some of the 10-year note yield gyrations, and we've seen here that basically over the last month or so that we've seen a drop of about 0.5% in fixed rate conforming mortgages. We're right at 7% right now, and you can see about 6.5% for 15-year fixed and FHA, and then jumbos are obviously a little bit higher on average. So a little bit of relief for home buyers, not enough to necessarily change the whole dynamics within the housing sector, but the trends are definitely looking lower. Got a couple of energy slides here. We've got natural gas injections looking a little bit lower. We're in this kind of a transition of shoulder season to the summer season, and but as we stand right now, we've got gas inventories a little bit lower, and so as a result, we're seeing a spike in the June contract for natural gas. And then on the crude inventory side, we do have inventories which showed a little bit of a downtick, and then this is crude inventories here, but then also after cracking, you've got gasoline, kerosene, some of the other distillates, and gasoline inventories heading into the what should be or what is expected to be a pretty active driving season here. You've got those inventories being down, so that could put some upward pressure on gasoline prices at the pump. So we've got the 30-year Treasury bond here, and again, entering the year, we were all convinced that we're going to have rate decreases, and that was, I guess, trying to put a floor, if you will, set a new floor on the under the 30-year bond. But since then, obviously, inflation has become a little bit more entrenched and stubborn, and so we've seen an uptick back after this interim low here, an uptick in overall 30-year Treasury yields. And you can see this is a 200-day moving average, which using technical analysis says that you're really kind of testing that right here. And if we were to end the year today with essentially those rate movements this year, we're actually going to wind up having a pretty sour year on the 30-year fixed. And so the trade that has worked has been to stay relatively short, capture those high yields, not go long, because you tend to have a lot more volatility and a lot more risk with long-term bonds. And so the heavy bet on long-term was that they were going to come down, and for a while it looked like, boy, this is looking like a real hero trade. But that is obviously reversed, and we've kind of like basically retrenched about half of our loss there from the peak rates that we saw back in roughly about the October time frame. Here we have foreign investment in U.S. debt, and this is really interesting. So this is from Bloomberg, but this is the official holdings of long-term treasuries, and that's a number that, I think misses a lot of the private market. But if you say non-official, which is kind of like the non-bank sector, and some of the other alternative investments, you can see that number continues to rise. So, we do have a lot of demand for our U.S. debt, which, when you think about it, that's increased demand, which is typically going to drive up prices, which in turn is going to help to keep your yields low, and that has something to do with the compression that we've seen in longer-term yields. And we have China as well. We know that we're in a trade dispute with China. It's not apt to get better anytime soon. And you can see the Chinese have been selling a lot of Treasury and U.S. agency debt. And agency debt would be like Fannie Mae, Freddie Mac, and some of the other issuing agencies. And so, this is pretty pronounced. Now, we saw bouts of Chinese central bank selling of Treasuries in the past, but this is something that could gain a little bit of momentum. Again, when you think about this, at least, so this is something that we looked at that prior chart, and it says you've got a lot of foreign interest in U.S. debt. Well, in this chart, you're looking at the fact that Chinese don't have a lot of interest, and so this is kind of a muting effect. When you're selling Treasuries, you're increasing the supply, which in turn is going to lower your prices, and it's going to increase your yield. And so this has the opposite effect from what's going on in the prior slide. So good news is that we've got good demand across the board outside of China, and that's helping to mute the impact here of Chinese selling in the Treasury market. So speculative grade default rates, and we were talking about this with credit cards earlier, but these are just speculative grade bonds, right? And so what is the default rate? Because we do know that credit spreads have been super tight. I mean, extraordinarily tight. I mean, the kind of spreads that you'd expect when you're in the middle of an expansion, not in a period where you're kind of trying to figure out if you're going to have a soft landing or not. But so we can see here, the U.S. is in this light color here, and we see those default rates moving a little bit higher. Again, about 5% on average. We've seen cyclical peaks. This is obviously the pandemic. This is what we saw about the middle of the last decade, and then this is the global financial crisis and its ensuing aftermath. And so, are we at a crisis point? No, but we are seeing enough defaults that it gives me a little bit of cause for concern on credit spreads kind of blowing out a little bit, which would hurt the return of speculative grade credit here. And we know that outside of the emerging markets, which we haven't seen really a lot of defaults there either, which is really interesting. But you see Europe and global, those areas are expanding, but EM and we're going to be talking about this in the coming weeks, really, is emerging markets have a lot of embedded value, and right now we're witnessing a fairly strong dollar because our rates are higher and likely a little bit higher for longer because all of these interest rate decreases have been taken off the table, and so dollar remains strong, which is generally not good for emerging markets. But when we do begin to see some rate decreases, then that's going to help the whole emerging market space act a little bit better. Here we have some equity, S&P 500 equity updates here, and you can see these are just price charts. This is the S&P 500 here. This is your NASDAQ composite. Again, we've had on balance a relatively good month in the markets, but you can look here in the green and you can see the relative strength index, and on both of these we're really pushing those levels, and you could say that maybe we might be a little bit overbought at this point. So again, as we just saw not too long ago where we had a little bit of a 5% correction, I think that could be the case in the early part of the summer. We do know that volume of trading tends to lighten up when people start to hit the Hamptons, hit the vacation circuit, and all that. Over here, we've got the forward PE ratio, and this is looking at the all-in versus the equal weight down here, and that's still trading at a fairly significant discount. So basically about 21 versus 17 times earnings. And so, if you back out the high flyers again that have gained a little bit of steam, although not in unison necessarily, but what's left behind is actually not terribly unattractive. I mean, right here would be the line of long-term average, and so where we are on an equal weight basis is actually not significantly different from that. And then finally, we look at foreign purchases of equities, and so a lot of people are looking for that juice. The U.S. is kind of the really one of the best markets out there, outside of maybe India and obviously Japan. And that long trade has been very popular this year, but we do see a significant uptick here, really in 2 of the last 3 months in the U.S. equity market. And as of now, you can see this transition going back to the global financial crisis when the S&P 500 market cap was about 22.5% of the global equity market cap. Now that's looking closer to 40%. So the U.S. absolutely matters in the global sphere. It matters a lot more than it did. You can see the influence that the S&P 500 has had on the total global investment landscape over the last decade. That will do it for the slide pack this week. I hope you've enjoyed it. Have a great week. We'll talk to you again soon.